Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is the BRN Sunday podcast. I'm going to be joined today by members of the media, academia, and financial services as we go around the globe to discuss and analyze all the issues related to retirement, the markets, technology, personal finance, so much more. We've got another great show for you this week, so sit back and relax and enjoy this episode of the BRN Sunday podcast. Well, let's kick things off with a look at technology. And joining me on the line, he is now the lead advisor and executive producer for 7 Investing. Let's welcome back Daniel Klein. Dan, welcome back to the program.
Hey there, Jeff. How are you? Yeah, a bit of a change for me.
Yeah, a bit of a change, but congratulations and on to bigger and better, I'm sure.
Very grateful to my friends at Motley Fool for helping me get where I'm going.
Absolutely. Well, we're on a journey. One way or the other, we're on a journey. Sometimes it goes up, sometimes it goes down. Congratulations to you and the team at 7 Investing. So let's jump right in because a lot going on in tech. We've been talking about fintech on the network. We've been talking about new iOS 14. I think you said you really like that. You think there's some really good tricks of the trade that can be used. Now we've got a new Apple Watch Series 6. What can you tell us there?
Yeah, so excuse me, Jeff. I was really excited about this, and then a friend of mine, someone who watches some of my shows, messaged me and he said, I got it, and I'm kind of underwhelmed. So here's the big improvements. One, it's always on. The old versions of the watch, when you put your wrist down, the screen went blank, and then when you raised your wrist, in theory, it would show you the time or whatever it is you're looking at. The problem is that didn't work all that well, so now it's always on. So that's a minor but important improvement. Mm-hmm. The second thing it does is it measures your blood oxygen level. Now, that's kind of a gimmick. It's not that useful. Your blood oxygen should be at about 95%. Now, if you track it every day and you notice it's getting lower, well, that might be a sign to go to the doctor, but it's not really actionable information unless you really track it. And then what's the big thing that's part of the new Apple Watch? It's sleep tracking. So you wear the watch, it tracks your sleep, and look, that's something Fitbit has done, but here's the problem. The Fitbit, and I'm wearing a Fitbit, I'm holding it up, though that makes no sense on a podcast. The Fitbit has 4 days of battery life. So I can go on a 3-day cruise, wear my Fitbit, and see that I'm sleeping 3.5 hours a night, and it's fitful sleep, or whatever it is. The Apple Watch only has 18 hours of battery life. So if I'm going to wear it to sleep, I have to charge it first thing in the morning or charge it before I go to bed. It gives you useful data. It does a good job tracking your sleep and giving you actionable, hey, you wake up in the middle of the night, you think you slept 8 hours, you only slept 5. That's really useful, but the Fitbit already does that, and the battery charging issue, I actually think is a pretty big problem.
Yeah, that's odd to me, Dan. I got to charge my watch before I go to bed. Some people charge their phone. I don't know. What's any rationale as to? Is it just that the battery's undersized, underpowered compared to what the phone draws? What's the rationale?
Yeah, I think the Apple Watch tries to be everything for everybody, and that means it draws too much battery. Look, it's physically somewhat intimidating compared to a Fitbit, and it definitely does more. But battery is really, really important, especially because it's not the same charger as your iPhone. So if you're traveling, you have to carry a different charger. You probably don't have an Apple Watch charger all over your house the way pretty much every port in every room I have an iPhone charger. Mm-hmm. So it's, in my mind, that's an Achilles heel. And I own at least 2 Apple Watches. That being said, I was thinking about buying this one, and I don't really see any reason to, especially with the new Fitbit Sense coming out, which is a much higher functioning phone from Fitbit, which is cheaper than the Apple Watch. It's probably not as good. The same friend told me he was equally underwhelmed with the Fitbit Sense. That being said, I don't know. I feel like maybe we've hit a wall on watch innovation.
Well, it sounds like if it's underpowered, sounds like they've got some innovative ideas, but maybe they need to rethink that. Maybe they just rushed it out to the market. Dan, the other thing I know you want to talk about is Ring. First of all, what's Ring, and what's new with Ring?
So Ring is an Amazon-owned company, and they do the doorbell, the video doorbell, which is really useful. So I have a friend who has one, and every now and then when we're traveling, he'll get a notification, and he'll see, they delivered an Amazon box to his house. So maybe he'll text someone who's inside his house to go out and pick up the package. Maybe it'll be someone at the door who's not supposed to be at the door, and he'll call the police. We've never had that happen, but in theory, that's something that could happen. So now Ring has made a drone to do security inside your house. So it is a little flying automated drone that in theory, flies around your house, and maybe it can detect, hey, your cat's knocked something over. That's important to clean up. Maybe they'll detect, hey, there's a robber. He's wearing the mask and he has the bag with the dollar bill sign on it. At your window, and you should call the police. But here's the problem: who wants a drone flying around their house? This seems like a pretty major privacy invasion, and it just doesn't seem like it's all that useful. Like imagine, Jeff, you're taking a shower and your Ring drone decides to fly around in the bathroom. Like, it just feels like something that I get why it might make sense when you're not home. I get while you're away it might make sense. But for the most part, this seems to me like an absolutely terrible idea.
Yeah, who came up with that? I mean, it just seems like I hate when flies or little gnats are flying and I try to knock them down. It just seems like a drone buzzing by, and they do make noise. It's not like they just like are it's not like Airwolf where they're on whisper mode and you don't hear or Blue Thunder, right? I'm dating myself. It just seems like a really and you bring up the invasion of privacy, the potential for invasion of privacy. I don't want a drone seeing what I do inside of my apartment or house.
Look, I see some uses for it for people who have homes that they don't live in regularly. So, I have we have a second home in Davenport, Florida, near Disney World, and there's only people in the house 4 or 5 days a month. So, when travel was allowed, it was more than that, but right now it's only 4 or 5 days a month. It might be useful for me. That said, I'm friends with my neighbors, and if someone was breaking into my house, my neighbors would notice, probably before the drone. So I see some uses for it, but it's very, very limited, and I think there's going to be a pretty major pushback. I mean, we're seeing a lot of people are thinking about, what do all the devices in my house do? What are they recording?
Yeah.
Amazon recently made it so you can automatically delete your voice recording on, and I won't say its name because it'll activate people's at homes, but their voice assistant that's built into the Echo and other devices. And to me, it seemed like, well, why were they storing that in the first place? Why would they have that data? We all have had the issue where, like, you have a conversation on the couch with your wife about something, and the next day that product shows up as an ad in your Facebook feed. I think people are thinking a lot about privacy, and a flying camera inside your house, that might be a little bit beyond what most people are willing to put up with.
I think you're right. I think a lot of people are thinking about this, and businesses. We've been talking at length about work from home, some of the challenges there, not only working from home, but managing data if you're a bit enterprise, right? A small or large enterprise, make sure that things are secure. I think a lot of people are going to be rethinking that in today's world, and whether they have an Alexa and how convenient that is, or a Siri, or some of these other devices where they put their data. Is how you manage data, Dan, is going to be critical through all facets of your life. And in fact, at the end of your life, it's going to be important to will your digital assets to other people. So I think this is a bigger issue that's going to be discussed from now probably in perpetuity.
Yeah, it is. I mean, it's a discussion I've actually had at home. Like, how do you know, like, what accounts you have and where you might have different things? And, like, I know there's certain accounts that, like, if I was, I don't know, killed by murder hornets tomorrow, there's stuff like my wife wouldn't know how to access. And I actually do have a friend that has a password list. So,
Yeah.
like, God forbid something could happen to me, he would be able to say, okay, like, Dan has an Acorns account, and here's how you get to that. And he has a TD Ameritrade account, and here's what's in that. Like,
Yeah.
it's gotten very, very tricky, and it also, like, changes so quickly. Like, it's so easy to open new accounts and do new things. I think it's something we're all going to have to rethink going forward.
Yeah, really interesting. Well, Dan, great analysis on Ring and great analysis on the Apple Watch series. Hopefully, we influence some viewers one way or the other. And looking forward to having you back on the network on Tuesday. Have a great rest of the weekend. We'll talk to you again very soon.
Jeff, I'll see you Tuesday.
Welcome back. Now, time to catch up on personal finance. And joining me on the line, she is personal finance writer for The Motley Fool and a wonderful mom who's now doing virtual learning at home, Ms. Mari Backman. Mari, thanks so much for joining us on the program this morning.
Always a pleasure, Jeff.
It's great. Well, it's great to talk with you. And you had a great last time you were on. You talked about your experience as from a virtual learning perspective and teaching your young children. How's that going before we launch into open enrollment?
You know what? We're getting into a bit of a groove. The kids are getting used to the setup, and we're getting used to it as well. Thankfully, both my husband and I are working from home, so I'm not alone in this. So we're definitely able to split the load nicely, which means that while we're both getting, disrupted a bit during the day, it's not like, oh, one of us is taking a 6-hour break to watch the kids while the other one just gets work done. It's really a lot more of an even split. And what I've noticed personally, Jeff, is that because a lot of my kids' activities, after-school activities, are now all virtual, instead of running around for 3 hours in the evening, we're home and the kids are able to just go online and do that. So I'm actually making back some time, making some time up just by not having to run all over the place. So all told, my schedule is manageable, and it's been going okay. But I definitely feel for the parents who are not in that boat, who maybe parents who are doing this alone or who have to report to a physical office and absolutely cannot work remotely. I'm sure this is really, really difficult for those families.
Absolutely, but hopefully they have support from family, friends, in their community to help them out, and that's how we're going to get through all this crazy stuff together. So, Mari, you write a lot of great pieces. I know you've written stuff on real estate. You've written stuff on retirement and savings. But today you wanted to talk about a very important topic that's here for so many people, open enrollment 2020. It's going to be like no other open enrollment, right?
Yeah, and to be clear, we're talking about the open enrollment that just, employees are going to have to start, picking their benefits, not talking about the Medicare open enrollment quite yet. That could be another discussion because that's starting soon as well. But, right, fall open enrollment, it's usually around October when employees start to get their benefits packages for the next year. They have to choose their health plan. They have to choose, what other benefits they want to sign up for. Do they want pet insurance? Do they want, to put money into a flexible spending account? And that's where things are going to get a little bit tricky for this year, I think, Jeff, just because of, everything that's been going on. I just think people are going to have a little bit of a different kind of decision to make this time around.
Well, I think so. And we actually had Megan Scipione, a financial wellness coach, on the program on Wednesday talking about some of this issue. And it's important, Mari, to kind of put side by side the benefits you're getting today, itemize what are some of the life changes that you're going through. Have you gotten married? Maybe you didn't get married during the COVID quarantine, but you got married earlier in the year. Did you have children? Maybe some people had children I'm sure people had children during the quarantine. All these things really need to be assessed and inputted into your benefit decisions, right, Mar?
Exactly. I mean, so there's a few different decisions you're going to be making. Usually you'll get an option for choosing a health plan, and you may need to choose, between a plan that maybe has a higher out-of-pocket deductible versus a lower premium, or vice versa. Usually the two have an inverse relationship, so the higher your deductible, the lower your premium, right? So, you'll kind of have to think about that. Well, would you rather pay, a higher premium, or would you rather just, take the chance that maybe you won't get sick that much and just go for the lower premium with the higher deductible? It's a tough choice to make. Obviously, there's also the HSA, the health savings account component to that as well. If you're on a health plan with a high enough deductible, and if your plan conforms to other, requirements, you may be eligible to participate in a health savings account. That could actually result in some huge savings because HSAs, the money that goes into those accounts, it goes in tax-free. So however much you contribute, that's the amount of taxable income the IRS can't count against you, so to speak. So if you put $3,000 into your HSA for 2021, you're not getting taxed on that $3,000, and that can make a huge difference too. So when you're weighing the decision of what health plan to pick, you want to look at all the individual numbers. You want to see what your premiums are, your deductibles are, your co-pays are, but you also want to think about that HSA. And the HSA, I'm going to say, is a pretty, I call it a pretty low-stress account. The reason being is that HSA funds never expire. It's not an FSA, which we'll get into in a minute. HSA funds you can carry for as long as you want. You can carry it. A lot of people, overfund their HSAs, in their 20s, 30s, 40s, 50s, and then they've got a huge lump of cash that they can use to pay for health care expenses in retirement, which is actually a smart idea. It's a pretty, but I call it a pretty low pressure account because, again, even if you put extra money into it, all you've really done is lowered your taxes and then you have that money for later on. Now, I want to talk, Jeff, for a second about the flexible spending account, the FSA.
Yep.
That's a little bit trickier. We're waiting on limits for 2021. For this year, for health care, it was $2,750 for health and then $5,000 for dependent. So health care is like money you can use toward, doctor visits, prescriptions, whatnot, certain medical supplies. Then your dependent care FSA is the money you can allocate for, daycare, preschool, summer camp, any service that basically allows you to have child care so that you can hold down a job. So you can't use a dependent care FSA for your 1-year-old's play group that you attend yourself, but you can use it for the daycare that you send your 1-year-old to so that you can do your own job. So the thing with the FSAs is the amount that you commit to during open enrollment is the amount that you're stuck with for the next year. And if you put in too little money, you can't add. If you put in too much money, you can't take it back. You lose whatever money you don't spend on eligible expenses. So that's going to be tricky, especially with the dependent care, I think, because a lot of people's child care plans for next year are still up in the air because, heck, we don't even know what schools are going to look like at the beginning of 2021,
I absolutely.
So,
Well, Mari, let me ask you this. I mean, so many Americans were laid off, furloughed, maybe lost their job completely. Now, some of that has come back, or based on if you look at the numbers, unemployment's come
Right.
down. But what about people who are out of work? I mean, they can go to the healthcare.gov website, the exchanges within their state, right, to get health insurance, get a benefit, and choose their plan.
Right, exactly. So if you're out of work, you do have the option to purchase private health insurance. There may be other options you can explore too. You can take a look at COBRA, which allows you to continue coverage on your old plan for up to 18 months. That may be an option for people who just want that continuity of coverage and expect to be employed in the near term. So if you're out of work right now, but hopefully the economy improves maybe in early 2021, let's say, or at some point in 2021, and you're able to get a job again in a number of months, COBRA might be an okay interim solution to look at. It can be expensive, but then again, so can buying your own health plan, just through the exchange. So you kind of have to weigh that. And then obviously, those who are married are eligible to get on a spouse's plan. I mean, that's generally your best option there, so that if you've been recently laid off and now your spouse is still working and your spouse gets his or her benefits package, you can take a look at that and say, all right, well, let me see how much it'll cost me to get on my spouse's plan, and chances are it'll be a lot cheaper than it will be to buy your own plan or even to retain COBRA coverage. So, that's obviously going to be a big consideration for a lot of people too. And what's tough, Jeff, also is that, we want to be optimistic and look at unemployment as a temporary situation. And for the most part, I mean, it is a temporary situation. The only thing is, for those who are, new to being unemployed, it's like, all right, well, in a normal economy, you might think, well, all right, I'm out of a job now, but I'll be back working, in a month or 2, 3 months maybe. So a lot of people in that situation will just take COBRA. That way they just keep the same plan. They don't have to do all this research. It's a little expensive, but it's kind of easy. But, that's an okay solution if you think your situation is pretty transient. But unfortunately, we may have, large clusters of people who are looking at being unemployed probably for 6 months, 9 months.
Yeah.
We just don't know. And it's those people who are going to have a lot harder choice to make now.
Yeah, absolutely. Well, Mari, thank you so much, one, for sharing what's happening from a virtual learning perspective, but also giving us some tips. You are our go-to personal finance journalist, and we appreciate you. And people who want to follow Mari can do so. Go to the Motley Fool website. You can look her up, and she writes pieces all the time on real estate, on personal finance, retirement. I mean, it really is amazing how much content she puts out. Mari, have a great, wonderful rest of the week, great weekend, and we'll talk to you again very soon.
All right, sounds great, Jeff. You too.
Bye-bye. Welcome back. Now time to talk real estate. Joining us on the line, he is Market Watch's real estate reporter, Mr. Jacob Passy. Hey, Jacob, how are you?
I am doing well. How are you?
Doing quite well. Beautiful day in the Charlotte area, and it's a little bit cooler, so the weather seems to be changing. But all things are good considering. What's top of mind for you this week? Lots going on, I suppose, in real estate.
Yeah, so real estate mortgages, yeah, lots going on. First off, this week we got the, monthly home price index, the Case-Shiller home price index came out. The kind of bottom line there is, home prices are going up very, very fast. So the question is now becoming, how sustainable this is. And there was an interesting report this week looking at, some of the markets across the country as to, how sustainable these increases really, really are.
Mm-hmm. So
And
go ahead, Jacob.
Go ahead.
No, I thought you stopped. Go ahead.
So UBS put out a report kind of arguing that the pace of home price growth, and they were looking actually globally, so not just in the U.S., is unsustainable in many, many cities. And so they, looked at cities all across the world, looking, at places like Paris, et cetera. In the U.S., specifically, when it comes to the rental market, they found there to be a lot of, unsupported price growth in cities like San Francisco, New York. And this is kind of a trend that we've been seeing, since the pandemic began, where, rents were, super high before the pandemic in some of these major cities, especially, San Francisco and New York.
Yep.
And now we have the trend of folks, looking to move to the suburbs and things like that. And I think there's still a little bit of an open debate about how much that's really happening. But to the extent that it is happening, to the extent that there might be some folks who are renting right now in a city like New York or San Francisco and wanting to buy, that leads to, softness in the market. And I've, done reporting, and, when you look at, Manhattan, things have improved, from a couple months ago, but, there is still, a lot of empty properties on the market, a lot of landlords struggling right now, and you're seeing price cuts to rentals. And so it's interesting to be looking at this, the trend of rent prices and home prices. They seem to be going up, but the question is, how long can that last? At what point do these things become too unaffordable? And so I think we're starting to see that now in the rental markets, and it'll be interesting to see whether or not that actually happens in the market for home purchases as well.
Jacob, are we at a point, we all recall the 2008 recession. Are we at a point where we could see something similar? You mentioned kind of I don't want to use the word bubble, but it is, the acceleration of home prices. Do we get into a situation, when do we know if we get into a situation like we were in 2007, 2008 with this bubble?
Yeah, so things are very different. And so, what happened in 2007, 2008 is, for years it had been super easy to get mortgages. Basically, there were lenders giving you mortgages without any proof of income, proof of employment, these no-doc mortgages as they were called. And a lot of them had pretty low interest rates too, so they were really attractive. And so you because of that easy access to loans, there was a massive surge in demand for homes, and builders started building in excess. They were building, I grew up in Florida. I lived in Florida at the time. And, all around me were, full, developments being built. But there weren't, there weren't buyers already lined up. This was a lot of speculative building. And so, then when a lot of these mortgages soured, when people who were put into mortgages that they couldn't afford, started defaulting, there was it was a perfect storm where, lots of people were being foreclosed against, and foreclosures, caused home prices to drop. But then on top of that, you had all this new construction that was, sitting vacant. And so this, those two factors combined such that, and because there was such a massive wave of foreclosures, that led prices to dropping. the demand, lenders had to cut their lending activities significantly. Folks were losing their jobs, so there wasn't a market to bounce back with new buyers and stuff. In fact, a lot of folks talk about the wave of private equity firms that bought up these homes and converted them into rentals, and often folks talk about it in negative terms. But actually, what those private equity firms really did back in 07, 08 is they actually put a floor on the market. They made it so home prices would have probably dropped even further had those firms not come in and bought up so many of these properties. What we're seeing right now in the market is very different. So since the Great Recession, home building has been much, much slower. And it's been so slow, in fact, that it's not keeping up with the pace of new household formation. So folks are getting married, having kids, etc., and they aren't, and builders aren't building homes at that same pace. So we're running about short of like 300,000 homes a year to keep, new homes being built a year to keep pace with, the number of new households that are forming nationwide. So right now, even if we start seeing defaults because of the pandemic or, folks deciding to, or landlords, deciding to, sell off their properties because they can't handle all the non-paying tenants they have, we're not going to see a repeat of 07, 08. Home prices aren't going to suddenly plummet because the demand is there, even, agnostic of, the pandemic causing lots of folks to lose their jobs. There is still such a need in this country for housing.
Yeah.
And you see that play out, in California with the homelessness crisis. There's such a need in this country for housing that prices will be elevated. They will remain higher. They're not going to, no one's talking about prices, maybe with the exception of a city like San Francisco or New York, and that's a very local situation. It's not, it doesn't really spread out beyond those areas. With those exceptions, we're not going to see prices drop. We might just see price growth slow. That is the more likely thing. And this is a good thing for, folks nationwide because, because prices are still rising, the good thing for folks who might be in a position where they're in default on their mortgage or anything like that, because the market is so strong right now, they could probably still sell and cash out of their mortgage and not have to worry about, they're not going to be underwater on their mortgage. They're not going to owe more than their home is worth. Their home will still be worth more than the mortgage, so they can sell, still probably turn a profit, wipe out that loan that's causing them trouble, and I guess, either find a cheaper home to buy or, find, a rental that they can afford.
Jacob, another question for you. You've got a couple minutes left, but is there concern on many, or have you heard of concern still about the affordability and for first-time home buyers? I know when you and I have spoken in the past, and I'm not going to put, I'm just paraphrasing here, that, a lot of people that are buying properties already owned one. What about those of us who have not owned a home before? Are we getting shut out? Are they getting shut out?
Yeah, there are, those concerns are valid. I mean, one of the big concerns about affordability, when we talk about affordability, mortgage rates are super, super, super low right now. I mean, we've talked about that at length. They're at record lows. They could go even lower. I talked to folks even today who said, next year could go even lower depending on what happens with the Fed and how they guide their interest rate policy. So the end of low rates is not in sight necessarily. So that's great news. And, a percentage dip in, the mortgage rate can, allow you to afford tens of thousands of dollars more in a home.
Right.
So that expands, a first-time buyer's options. The flip side of this situation is low rates also allow prices to go up. If rates are low, you can buy more homes, so you're not, buyers in the market are not necessarily as stressed out about rising home prices. Mm-hmm. What it does for the first-time buyer, though, who doesn't have, a home that they already own that they can, kind of draw on for equity to, put forth in towards, a down payment or something like that, or whatever, is, as the home prices go up, the amount that you need to make in a down payment goes up. And so that is where the affordability thing becomes a bigger concern is, it's not so much about being able to afford the home once you're in it, because the mortgage, the mortgage rates being what they are, you can probably still have the same monthly payment, but buy a larger home now than you did a year ago, or a more expensive home now than you did a year ago, and pay the same each month. But what's going to be harder is the savings, funneling that money into a savings account or whatever, you're doing to ensure that you have enough to put forth a down payment. And right now also in the market, because of the low rate environment we're in, so many people are scrambling to get refinances, to get, purchase loans. And so the mortgage lenders can be picky. They don't have to lend to anyone who comes in front of them. They can just lend to the best of the best. So they are more likely to lend to folks who have larger down payments, who are already home buyers, or homeowners, I should say, folks who are less risky to lend to. And so between having to save up more for a down payment and the trouble some folks might face in terms of finding a lender willing to lend to them, you might have troubles as a first-time home buyer in today's market.
Yeah, really. Jacob, this is an amazing segment. Lots of good information there. I hope people are taking some notes out there. If not, they can always replay the segment. Jacob, thank you so much for joining us on the program this week, and we look forward to catching up next week for some more real estate news. Have a great weekend, and we'll talk to you very soon.
Talk soon. Take care.
Bye, Jay. Bye. Welcome back. Now time to take a look at the latest social media trends. Joining us on the line, Devin Banerjee. He's Senior Financial Services Editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which, of course, you can find on the LinkedIn platform. You just got to click Devin's name. Devin, thanks so much for joining us again this morning.
Absolutely, Jeff. Always.
Yeah, it's double duty again for you. Great segments on the network. Great information. Lots of, I hope stirs a lot of conversation. Excuse me. But what's top of mind this week as you look back on the platform conversations?
Yeah, absolutely, Jeff. Well, we're recording this on Friday, October 2nd, and it is the Jobs Day, first Friday of the month. And actually, importantly, it's the last employment report out before Election Day. So it's getting a lot of attention today. Kind of a mixed report. The U.S. economy did add about 661,000 jobs in September. Sounds like a good amount on an absolute basis, but it is the lowest amount since May. So reinforcing that storyline that started to emerge last week, actually, which is that the recovery in the jobs market is starting to slow. Nevertheless, the new payrolls did tip the unemployment rate lower. It's now standing at about 7.9%, down from 8.4% in August, and of course down from that 15% level we saw in April. Digging under the hood a bit, Jeff, if you remember, you and I spoke about a month ago about this concern that there's a more permanent underlying recession within the recession, if you will. So some of the data points that came out this morning do reinforce that. The number of permanent job losses did climb in September by about 345,000, now standing at a total of 3.76 million. So those permanent losses in jobs. So again, reinforcing concerns about this pandemic's duration, reinforcing concerns about the stalemate we're seeing over a new fiscal stimulus bill, which we can get into later on. And then a couple other points under the hood that were interesting. One unfortunate one I'll start with, which is that women, professional women, have been leaving the workforce at the quickest pace since earlier this year, since the start of the year. So, many schools remain closed, many daycare centers still remain closed. We're starting to see that effect really kick in. And then on a better note, the delta or the gap in the jobless rate between Black and white Americans actually tightened slightly for the first time since April. So some good news there as well.
I was going to say, leading into and kind of dovetailing back to our story earlier on the network about Black executives hitting some ceilings, this is obviously a good sign, but obviously a lot more work to be done there, Devin. This is our last economic report before the election. I guess my question is around, how do we change some of this negativity, the permanence, as you will, of some of these job losses? I mean, there's got to be something that can be done to kind of stimulate that. Is it just overly dependent on the stimulus package, and that's what kind of kept some of these jobs afloat? And now that that has kind of subsided, there's this is the rationale as to why there's more job losses?
Yeah, it's a great question, Jeff. I would say in the near term, the very near term, some fiscal support is certainly what people are looking for. I mean, also this week we saw some real huge job cut announcements. Disney, you may have seen,
Yep.
laying off 28,000 workers at U.S. resorts, Allstate, 3,800 workers. The airlines are super dependent right now on continued fiscal support and even a specific airline support carve out, which as of this recording, it's about 1 p.m. Eastern time on Friday. House Speaker Nancy Pelosi said an airline deal is imminent. But of course, if we've learned anything learned anything about Congress over the past 6.5 months, of course they have good intentions, but imminent does not mean what we think it means. So I would say the airlines are super dependent on that as well. But also to your question, Jeff, there is a longer term shift we're seeing and a strategy for those who are losing their jobs. And actually some data out from our Workforce Confidence Index this week was related to that, which is that among unemployed people in the United States who LinkedIn surveyed, a lot of the conversation in the media and between friends and family has been, people must be, thinking about relocation or moving. But really what we're seeing as the most popular strategy for those who are unemployed right now is pivoting to a different industry or a different job function within your same industry. So it's really looking for those pivots, those tangential movements where people can apply existing skills from their current function or their most previous function or industry into a new one. And so that is really important. That takes a little bit of reskilling, retraining, and also a little courage to look outside of your existing industry or job function. But that is actually the strategy we're seeing most unemployed job seekers taking right now.
And as someone who has kind of done that, I can speak personally that is does take it is nerve-wracking. It is a lot of pressure. There's fear that goes through your head, and I can certainly understand that. But there's got to be ways to develop training programs, either while people are employed, but people have to voluntarily. I mean, you can't make things mandatory, but people have got to voluntarily try to learn new things. I mean, if you're in manufacturing, maybe you kind of dovetail that into something else that is similar but not the same, and I think we all have to be thinking that way because the economy is only going to keep changing because and we've talked about this, we've got artificial intelligence, right, Devin, and other things that are changing how the workforce is what the workforce looks like. So I think it's up to us as individuals to continue to want to change and develop and grow and evolve.
Yeah, I totally agree. And final item I'll mention, Jeff, is related to how the economy will change because of this crisis and this pandemic. It's actually a report from RBC, Royal Bank of Canada, about how the pandemic will change the Canadian economy. But we saw this item popular across the globe. That's one of the great things about the vantage point that I and my team have. We can see what is trending, what is popular. So this report from RBC had a couple points about how the economy will change long term. So number one, as remote work proliferates, firms are going to start seeking out suppliers and other service providers who can increase productivity at home, even if that means physically reconfiguring traditional offices into home offices or home office setups, all the way to software providers, of course, communication software providers, collaboration software providers, etc. Some other interesting points, people are going to want to find ways to engage with art, with music, with culture, online and virtually. That's something a lot of us are really missing. Of course, the rise of e-commerce will continue. That's going to make data more important. That's going to make bandwidth access more important. That's going to make cybersecurity more important as well. When it comes to the travel trends. Travelers are becoming more interested in local travel, more interested in eco-tourism as well. In the healthcare realm, you and I talked about this several times, the demand for digital delivery of healthcare and telehealth is just going to continue increasing. And then in consumer spending, RBC is seeing that more people will want to buy locally and support local business. So some really interesting high-level themes that, again, as I said, were specifically being discussed in the context of the Canadian economy, but we saw people across the globe reading that, probably recognizing those trends in their home economies all over the world.
Yeah, I think what happens somewhere else is eventually going to happen here or vice versa. I mean, you can't just be living in a vacuum and just thinking that, oh, it's over there. It's thousands of miles away. It's not going to happen here. We are all interconnected, Devin, and that's I think the key lesson here.
Yeah, absolutely. I agree. And actually, let me slip in one more item because it's related to retirement, and it's something I've been watching closely. It's a working paper, Jeff, out of the University of Chicago, saying that more older Americans are retiring earlier than planned because of these unexpected job losses triggered from the pandemic. So instead of choosing to seek out employment again or new employment, those who are aged 55 and older, these researchers are finding that many of them are just choosing to retire early, even when they are not prepared to do so financially. And so unfortunately, according to this research, let's see, in the next 10 years, the number of elderly people experiencing homelessness may triple from where it is right now. And yeah, just this trend of retiring early without being financially prepared. I think we're going to be talking about that more after this economic recession, unfortunately.
I completely agree, and it's something that unfortunately I think we're going to be dealing with this. This is a generational thing, so this is not going to be solved in a year or 6 months. I mean, this is just a major demographic shift for people, and getting people to save, Devin, not easy, and it's really hard to do if you're not making a lot of money, because you got a lot more percentage of your money goes towards rent and things, food and shelter and all those other things. So yeah, we're going to be discussing this for a long time. Well, Devin, great stories as always, and thanks for bringing all these great stories to our attention, and we look forward to having you back on the program next week.
Sounds good, Jeff. Take care.
Thanks, buddy. Bye-bye. Welcome back. Now time to talk markets. Joining me on the line, Kevin Kelly. He's co-founder of Delphi Digital, and he's also a reformed equity strategist. Hey, Kevin, how are you? Welcome back to the program.
Doing well, Jeff. How about yourself?
I'm doing well. Thank you so much. So let's just jump into it. I mean, this has been a very volatile week. I would say September, not a great month for the stock market. We just got some job numbers today. We're recording this on Friday morning. And then we also found out that the president and the first lady, among many others not many, but others in the administration, are diagnosed with the COVID-19 novel virus. So break it down for us. I mean, what do we take from all these crazy news, and what's the underpinnings here? What are the underpinnings here?
Yeah, it's crazy how much has happened in just a 24-hour stint. But I mean, that's the world we live in at this point, right?
Absolutely.
I think the bottom line, the COVID numbers, or the COVID with Trump, I'll get to in a second, because there is definitely some potential implications from that, even though it seems like it could be a relatively isolated case. But the job numbers came in weaker than expected across pretty much, every notable metric. You've seen permanent job losses actually reach, I believe it was 8-year highs at this point. So you're really not seeing the labor market come back as strong as I think a lot of people had anticipated earlier this summer. Along with that comes this idea of, if we have this economic recovery starting to stall out, and that rebound off of, again, one of the worst kind of quick contractions in economic growth that we'd seen since the Great Depression, following in the immediate aftermath of COVID. The fact that you're starting to see the job market stall, the economic recovery stall, is really starting to, and we've, again, on your show been talking about this for weeks now, it's really starting to show up in markets, because everyone everyone is now, unless you have some type of fiscal stimulus bill and deal that gets passed, relatively soon, and by that I mean within the next few weeks, things are really starting to turn a bit sour here. And so what I meant when I said I would come back to the COVID numbers is one of the things that's interesting, or I guess a potential, I don't want to say a silver lining because it's absolutely not the case, but one of the potential implications of Trump and the First Lady having confirmed cases of it is this could actually be something that spurs the both sides of the aisle to basically come together and try and at least get some type of stimulus bill passed before Congress heads for recess before the election. And I think, honest to God, we talked about how this entire market is one big macro trade, and we put out our most recent market and macro outlook last week, actually highlighting literally exactly this. But long story short, it's all based on global policy expectations, and right now fiscal stimulus, at least in the U.S., is absolutely front and center.
Well, I think a lot of people feel that way, and if you're just watching the stock market kind of whipsaw over the last month, and as we're talking, I haven't seen the market, but I know this morning when it opened up, Dow futures were down significantly, and I think things dropped precipitously. People are looking at, how do I mitigate this? How do I weather the storm? What's going to be next? I mean, even if we get a new president, there's still going to be tumult. I mean, you know what I mean? It's not like one issue doesn't always drive the market, and one person, whether they're a president from one party or the other or anything, drive the market, or they're going to make it better. I mean, that's just impossible because people can't control the market.
No, absolutely. And I think regardless of who winds up being the president-elect following the November election, which, again, we don't even know, the timeline in terms of when we're going to know exactly who is the next president or if it is another 4 years of Trump. But bottom line is the underlying really kind of, systemic issues at this point that are structurally almost embedded into the economy, given we're now, 6-7 months into this thing, is a tall task for whoever's in office, right? Whatever administration's there. And it's not something that, if Biden ends up winning, that it all of a sudden gets solved, right? It is going to come down to, you're going to have some type of bipartisan agreement, and you're going to have some type of compromise. And, the unfortunate reality is what I think we're watching is literally the deterioration of, for at least a while, one of the greatest democracies, the world's ever seen. Now you're really starting to see that be literally eroded in front of our faces because, they can't come together on something that is so primitive to not only just the success, but the survival of, the underlying economy and all the people who make it up. I mean, we're just watching that trust in government institutions really start to be eroded, and it's an unfortunate reality, but it's the world we're living in.
Yeah, I'm just wondering if we rely too much on the federal government, and maybe that's where the eye opening is. But let's switch gears because I'm not going to put you on the spot to answer that question. We can talk offline in the green room about that. But let's talk about cryptocurrency because, as I joked, you are a reformed equity strategist, but now you're the co-founder of Delphi Digital. What's been top of mind this week? And I know you said you just issued a report, but what's going through all your heads?
Yeah, so I mean, from a market standpoint, this week has been a really tough one for crypto as well, especially a lot of your smaller kind of alternative crypto assets that, again, are more higher beta plays on the entire crypto movement. There's been some really heavy selling pressure. One of the kind of catalysts that certainly didn't help within the last, again, 24 hours has been absolutely crazy. One of the catalysts that pushed the Bitcoin and crypto sell-off today was you had news yesterday coming out that the CFTC had actually filed charges against some of the founders of BitMEX, which is one of the largest kind of derivatives exchanges, very, very well known and popular within the crypto world, both among retail investors because they don't have KYC and AML procedures, which is why it's very popular, but also among more kind of professional crypto fund managers and traders. So that news coming out certainly has had an effect on the market. We look at Bitcoin at 10,500, where it's trading right about now. And obviously long term, we think that's certainly a buying opportunity just because of everything we were just talking about in the previous segment about where the markets are and the macro outlook. But in the short term, and this is something that we continue to reiterate, the crypto markets are not isolated from what happens in the global macro sphere. And so if you have this period of more deflationary pressures, you have a sell-off, a rapid sell-off in risk assets, you see more weakness in stocks, unless there is something that fundamentally changes within the outlook, you certainly could see, Bitcoin and crypto continue to weaken further, alongside some of those riskier asset classes. But again, that's all a matter of short-term, thinking or potential projections versus what we think long-term, obviously, is, the next major asset class to take the world by storm.
Kevin, you mentioned thanks for that, and you mentioned the charges being filed here. I mean, does that hurt the legitimacy, or does that play into the naysayers about some of these more newer asset classes, these newer digital assets, when they can point and say, oh, they did this, they did that? I mean, I don't think piling on makes a lot of sense, and I don't think you can paint a whole industry, but by one person or multiple people's behavior. But does this kind of play into that?
Yeah, I mean, it certainly gives fodder for the crypto naysayers. Absolutely. That being said, anybody who's been in this market or is familiar with this market is probably well aware of who BitMEX is and what they do. And those who really spend their time in this space, it came as a surprise in terms of the fact that the CFTC actually did something about this, but it wasn't necessarily a huge shock, if that makes sense, to the rest of the community, because again, BitMEX has been operating in a very kind of gray area for a long time now and has had incredible success by being there because there was such a lack of kind of regulatory oversight for the kind of day-to-day operations of the business. So long story short, yes, can have a short-term impact. We're seeing it have a short-term impact. Longer term, I don't think it's anything. And to be honest with you, I think BitMEX still survives in one capacity or another. I think it'll be more of a slap on the wrist for the company itself, and they'll have to obviously, revamp what they're doing. But longer term, I don't think it's going to have, a material impact. But it is, to your point, another, thing that people can point to if they are crypto naysayers and say, listen, this is still, the Wild West, and things like institutional investors and sophisticated investors, it certainly could serve as another headwind if people were looking for one.
Well, Kevin, speaking to that point, I mean, what is the best way if you're an individual investor, an institutional investor, outside of reading the Delphi Digital Research when it's published, but what is the best way to get into and understand the marketplace so that you don't fall into some of these traps? Because I aggregate news every day, and I see a lot of things. A lot of currency scams, and they're not all crypto. I mean, there are scams in hedge funds and scams in traditional asset classes and things that exist. But what's the best way for a novice investor to get themselves educated to avoid these types of mistakes?
Yeah, so I would say there's obviously a ton of, especially crypto news, and this space more than any, I think, is certainly prone to a lot of, misinformation. What I would say is, yeah, of course, follow us on Twitter. We're constantly trying to post things and some of our free research, but news outlets like CoinDesk are very highly regarded. The Block is another one, a news outlet that covers a lot of this space. I would also say, I mean, it's a bit of a cop-out answer, but I would say a lot of the information that we get as well is just from not only talking to people, but following the right people on social media and things like Twitter. It's incredible how much I joke around, I can't believe Twitter is still free because of the amount of information that you can actually get and decipher from following just the right types of people, within the crypto sphere can certainly go a long way, and honestly can probably do a lot better than even following some of the more prominent news outlets.
Yeah, well, I mean, I think there's a lot of great information out there, and it, I think people just need to spend the time and sift through it. But you can't be you can't rush into things, and I think you need to really be smart and think longer term. If you are a traditional retirement investor, a savings investor, or even someone working on a pension, I mean, this is a buy and hold type of play, right?
Yeah, no, absolutely. I would say though that this market more so than any other, I think, is one in which it's not very conducive to a passive investment strategy. And what I mean by that is, yes, the buy and hold strategy for something like Bitcoin, absolutely, fully support. But I think that in order to really fully understand what's happening here and to understand where the opportunities, long term can be, it requires, that person, to your point, to kind of take it upon themselves to do their own due diligence, to kind of get in the weeds and really start to learn about this stuff. Because again, it's extremely exciting and very revolutionary, but at the same time, it's very susceptible to pitfalls and potentially even misinformation or fraud, because there is just so much interest and so much capital and so much mind share that the crypto market is starting to steal.
Yeah, it's fun to watch. I'm sure it's fun to be in the middle of all that, Kevin. And we love talking about both the markets and crypto with you. Have a great weekend. Thanks so much for joining us on the program, and we'll talk to you again next week.
Absolutely. Thanks for having me.
Thanks, bud. Bye-bye. Welcome back. Now time to talk a little bit more about retirement. On the line, she is the retirement reporter for Dow Jones Market Watch, Ms. Alessandra Melito. Hi, Allie. Welcome back to the program. Great to talk with you.
Hi. Thanks so much.
So let's get into it. What's been top of mind? Obviously, we had the first presidential debate. I didn't hear a lot about retirement policy there, but what's top of mind for you and your fellow market watchers this week?
Well, it's definitely been one week, all right, with the news cycle. But so the presidential debate, you're right, there wasn't a lot to talk about as far as retirement goes, but they did mention the economy, and President Trump did mention 401ks. So it was just a side remark, but he does talk about 401k plans whenever he does mention the stock market. It was in the middle of talking about the economic recovery and just the kind of economy that he had inherited from President Obama. And he said, when the stock market goes up, that means jobs. It also means 401ks. And honestly, that is a talking point that he has used numerous times before. Every time the stock market is doing well, or just there seems to be some sort of rise, especially with this market recovery that we've had since the beginning of the pandemic. He mentions 401k plans and retirement savings plans. Like earlier this summer, he had talked about how with any other president, 401k plans and retirement savings would be dropped down to nothing. The good news is he's right. When the stock market goes up, 401k balances tend to go up too. Of course, though, that doesn't necessarily mean that Americans are better off for it. There was a survey that came out of Bankrate, and they talked about how participants mentioned how they think they're doing personal finance-wise under this administration, and it was pretty like what you could expect of a poll. 25% or so said that they were doing better since Trump became president. I think 40% said that it's been the same, and 25% said it's been less, and then some people were probably unsure. The truth of the matter is, like any other type of investment portfolio, it really depends on what is in your portfolio that will determine if the market is doing well for you or not. Like if the S&P 500 is doing well, and that's something I think more Americans should know. It's very personal to you and the investments that you have in your account.
That's a really good point. And also, not every American has a 401k. We have talked about this numerous times. Yeah. There are many Americans who do not, because they work for a smaller employer, do not have access to an employer-based retirement plan. Now, some of the states are looking to offer a similar type of plan. It's not exactly the same because the limits are different. And we've seen MEPs and PEPs be part of the Secure Act to offer, for bands of employers to run together. But I agree with you that, just like life is a individual experience, your 401k or your retirement savings experience is going to be individualized as well, Allie, right?
Yeah, I mean, it really depends. So, people who are younger, whatever the general index does will, probably drastically affect your portfolio because, you're going to be more in equities than somebody who is maybe closer to retirement and has, stronger funds. And then there's also, how interest rates affect your portfolio, based on your investments. So there are just so many different variables. So it's not if the stock market is, jumping, that automatically your balance, doubles or something like
That's
that.
right.
It really comes down to whatever is in that account. And that's why it's so important to have, to review your asset allocation and to make sure that you're diversified and to really take into consideration what is, what you are invested in based on your age and your retirement goals and just everything else, that goes into financial planning.
Absolutely. And I'll just add, you've got to, don't look at your account balance every day. You should maybe look at it once a quarter. Don't day trade. That's not going to get you anywhere. You can't beat the market. Allie, it's always a pleasure chatting with you. I always learn some insightful comments from you and the rest of our great contributors. Thank you so much for joining us on the program this afternoon or this morning, and we look forward to chatting with you again next week.
Great, thank you so much.
Bye-bye. Welcome back. Now time to check in on what's happening on Capitol Hill. And, hey, there's nothing going on, right, guys? Joining me on the line, David Levine, Kevin Walsh, both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, how are we this morning?
Jeff, we're doing well, and unlike some TV shows that have gotten great ratings lately, we're going to try not to have all three of us talking at the same time and talk over each other.
I know, and I just did it to you, Kevin. I don't even know how we did that. Maybe we need to restart. Or in the vein of a debate, why don't we just keep going?
I think
Is that how people debate now? We just talk over each other?
Kevin, you got to stop. You're not listening to me.
Yeah, I mean, we had, I mean, look, I'm going to moderate.
Jeff,
Yeah,
you're
David.
supposed to be silent. Let Kevin and I go at it,
All right, okay, you guys go at it. What's top of mind this week? Someone start and the other one interrupt.
Okay. All right, well, humor aside, what we thought we'd talk about is every day you see literally a new lawsuit filed. And Kevin and I are on the defense side, so we have some strong views about
David, is litigation fake news?
Litigation is not fake news. Unfortunately, it is real news if you would actually read the paper, Kevin. But moving on, the key takeaway here is, you see these cases, and as I was saying, Kevin and I are on the defense side, and we have some strong views. And we're concerned about the stifling of innovation and other types of things. But rather than get into some bombastic things where we interrupt each other, maybe what we could do this week is talk a little bit about, well, what are some things, plan fiduciaries could keep in mind? And we're going to say one thing. Plaintiffs' lawyers love to say, this is what is right. ERISA is not, and the laws that govern your retirement plans are not black and white vehicles.
So, David, would it be accurate to say that if people present it black and white, it's just malarkey?
Kevin, I need to know if you stand for litigation or not, and I want a black and white answer on that one. But moving back to my topic, because I'm talking to you, our listeners, and not to you, Mr. Walsh. And to that point, I think it's important to keep in mind there is no best practice, despite what plaintiffs say. A statement that there is one way it must be done or one price is just not required by law. But rather than us sit here and talk about attacks on different things, let's talk about some substance. Kevin, do you want to go first, or do you want me to go first on talking about something people look at in their process and a lesson from litigation? And once you start talking, I'm going to interrupt you anyway in the theme of the week.
Well, I was hoping that you would go first, but then I would get to respond first.
Okay. Well, that means I'm going to go first, and then you're going to interrupt me while I'm talking first. But let's begin with that. But one of the really hot topics you see these days, target date funds, managed accounts, what's right, what's wrong. The reality is there is nothing saying you must have targets, you must have this default investment, you must have managed accounts. But the right answer is, if you're going to look at any of these, it is important as a plan fiduciary to say, why am I doing it? There is no one right answer. Cost is always going to be a part of the discussion, but it is not the be-all, end-all. So when the plaintiffs say, oh, this was too expensive, you should just use a cheap target date fund, you should just use a cheap managed account. That's not the point. The point is, we are focused on outcomes here. So if you document how you negotiated, why you negotiated, what your pricing, what your selection was, why you selected whether it's a fund, active or passive, I'm not going to get in the middle of that battle, why you selected a managed account provider, what you think is valuable. And also, it's important to think, okay, when we revisit and monitor down the line, let's talk about our monitoring.
But there is no one way to do it.
I think your
and
2 minutes are up,
steps and
Mr.
document
Levine.
things,
I think your 2 minutes
you
are up.
could be in pretty good shape. That is a good way to actually begin down this road, and that is the starting point on this.
Kevin, go ahead.
So David,
There's actually a lull. There's actually a lull here. I'm going to interrupt. It's actually a lull here. Go ahead, Kevin. I'm sorry.
You made some great points, David. When I think about what plan fiduciaries are thinking about when they're designing their default investment options, so, typically targeted funds, typically managed accounts, occasionally things like balanced funds, it comes down to, documentation and diligence. So when you look at your investment policy statement, if you're a committee, when you're deciding how to choose options, is it consistent with the guidelines that you've selected for yourself? And then when you're evaluating specific options, specific products, specific providers, it generally helps to compare them to other providers to have a basis for the decision you're making, and to have some documentation to back that up, because as David pointed out, you can basically tell what day it is by keeping track of how many claims have been filed. Rarely does a day go by where there isn't a new fee case, and there's no silver bullet here, but as the case law develops, it seems like the plan fiduciaries who tend to get better outcomes, they tend to have better documentation. They tend to be able to show that they perform better diligence. And so, unlike some debates that we may have seen lately or TV shows, thoughtful process goes a long way. David, do you have anything you want to add? Because you just let me go for the full 2 minutes.
Yeah, that was surprising, actually.
Well, I honor the terms that both our relative campaigns agreed to, Kevin. So therefore, at this point, I feel good. Jeff, we've certainly had enough time and enough humor here. If everybody notices, we're not picking a side in this battle, because you know what? Kevin is a good guy. Maybe I'm a good guy. But the point is, we're not going to get into there are good people on all sides. And we're not going to get into other gaffes that other people on each side of the aisle may have made. But I think we're
Snyder
done for this
2020?
week.
God, no.
Snyder 2020?
Yeah, he's the Jeff, I thought you were the VP for Kanye.
Yeah, I'm not going to. I don't want to even touch that. I don't want anything to do with any of that. I'm going to stick to BRN and the Broadcast Retirement Network. I think that's where I can do the most good for the most people. So unless I get drafted, you can write in my name, but I'm going to stick to what I do best. I appreciate that, though.
So you heard it. Vote early, vote often, vote repetitively for Jeff Snyder.
Oh, gosh. Well, gentlemen, I want to say thank you. In all seriousness, this is going to be something that continues to creep up. You cannot avoid. If someone wants to sue you, they're going to sue you. But how do you protect yourself? I think the Legal Eagles just laid it out very clearly. Do your due diligence, write things down, or type things down, I guess, at this point. Gentlemen, thank you so much. We appreciate the humor, as always, and wish the Legal Eagles some fun soaring this weekend. Have a great weekend. We'll talk to you again next week.
Thanks, Jeff. We look forward to our next 3 debates.
Thank you. Bye-bye. Well, that wraps up this episode of the BRN Sunday podcast. I want to thank all of you out there for joining us this week. I want to thank all of our great contributors. Don't forget, we're back again tomorrow. That's Monday. We're going to be joined by Joe Rollison of 3+1 Advisors. We're going to be talking about cash management for many states and municipalities. You're going to want to tune into that one. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.